In the grand theater of global finance, disaster rarely announces itself with noise. Instead, it whispers quietly through rising interest rates, unchecked borrowing, and the illusion that the system is too big to fail. Today, economists warn that the world is heading toward a seismic event, a debt collapse by the year 2030. This is not speculation, it is mathematics, and mathematics never negotiates. Global debt has crossed $315 trillion, a number so large that it defies human comprehension. Governments borrow to survive, corporations borrow to expand, citizens borrow just to live. Debt has become the oxygen of the modern world, silent, invisible, and dangerously addictive. But like all addictions, there is a breaking point. Economists rarely use the phrase collapse. It sparks fear, it causes instability, and most importantly, it challenges the illusion of control. But behind closed doors, many admit the same thing. Global debt levels have entered a zone that no historical model can safely explain. We are in uncharted waters where old assumptions no longer work. Debt wasn't always dangerous. In the early 20th century, nations used borrowing to accelerate development, build infrastructure, and invest in the future. But by the 1980s, debt transformed into a weapon of financial engineering. Through deregulation, globalization, and complex credit markets, debt became the lifeblood of economic expansion. Growth wasn't earned, it was borrowed. Every dollar borrowed creates a ripple that multiplies across the economy. Businesses hire more workers, consumers spend more freely, governments fund new programs. But when that same debt becomes too large, the multiplier effect reverses. Growth slows, spending freezes, governments tighten budgets. Debt stops being a tool and becomes a trap. For decades, low interest rates made borrowing feel safe, but starting in the mid-2020s, everything changed. Central banks raised rates sharply to combat inflation. Suddenly, the world became more expensive for borrowers. Nations that once paid billions in interest now paid trillions. Companies that relied on cheap financing faced bankruptcy. Households struggled to afford basic loans. A global system built on debt began to strain under its own weight. Economists use one critical measure to evaluate debt sustainability: the debt-to-GDP ratio. When a country's debt surpasses its economic output, the system becomes mathematically unsustainable. Today, more than 40 nations have crossed this threshold. Some, including major world powers, have gone far beyond it. These ratios don't represent numbers, they represent warning sirens. Governments often reassure citizens that debt is manageable. They use phrases like temporary, controlled, or strategic. But hidden inside financial reports are alarming details that most people never see: unfunded liabilities, shadow banking exposure, and speculative derivatives. These invisible debts are the real danger because they multiply in the dark. Why do economists point to the year 2030? Because several debt cycles across governments, corporations, and households converge around this period. The global aging population will strain pension systems, climate-related spending will surge, massive loans taken in the 2020s will mature. Shocks in one region could spread globally in hours. 2030 is not a prediction, it's a convergence. A collapse doesn't begin with a crash, it begins with pressure. Pressure on budgets, on families, on central banks. Pressure that builds slowly until one small spark ignites a global chain reaction. Every major financial crisis in history followed the same pattern. And today the world stands at the edge of the same pattern once again. The modern debt system began after World War II, when nations realized that rebuilding the world required more capital than any single government possessed. Debt became a strategic tool, a bridge between devastation and prosperity. What started as necessity soon became habit, and habit transformed into dependency. The global economy learned to grow not through production, but through borrowing. In 1944, the Bretton Woods Agreement redesigned the financial world. It tied global currencies to the US dollar and the dollar to gold. This created a predictable and stable system, but also paved the way for massive borrowing. Nations suddenly had access to liquidity like never before. This was the foundation of global debt: trust in the dollar, and trust in America's economic dominance. In 1971, President Richard Nixon ended the gold standard. Overnight, money became completely abstract, no longer tied to physical reserves. Governments could print more currency, issue more debt, and expand credit without restraint. This moment marked the true birth of the modern debt bubble. Money became limitless, debt became infinite, and inflation became inevitable. During the 1980s and 1990s, global financial deregulation unleashed a new era. Banks merged, expanded, and gained unprecedented power. Credit cards, mortgages, derivatives, and corporate loans exploded in volume. Debt was no longer a financial instrument, it became a product, and the world's largest banks became the manufacturers. This era planted the seeds of future instability. Beneath the official financial sector exists a hidden world, known as the shadow banking system: unregulated entities that create credit without oversight, Hedge funds, private equity groups, money market funds, and offshore financial networks borrow trillions in secret. These institutions escape regulatory frameworks, making them both powerful and dangerous. When the next crisis hits, this shadow world may amplify the collapse. Governments borrow money through bonds promises to repay in the future, but over the last 3 decades, governments began borrowing far more than they could repay. They justified the borrowing with optimism, future growth, technological breakthroughs, stronger productivity. But when growth slowed, the debt remained. Today, many nations borrow simply to pay the interest on existing loans. This is the beginning of a sovereign debt spiral. Corporations discovered that borrowing was cheaper than innovation. Instead of investing in new technology, many companies used debt to buy back their own stocks, raising share prices artificially. Others used borrowing to expand rapidly, without sustainable revenue. As interest rates rise, these corporations face a brutal reality. Their growth was borrowed, not earned. When the corporate debt bubble bursts, millions of jobs may vanish. For ordinary people, debt has become a part of daily life. Mortgages, credit cards, student loans, auto loans. Most households owe more than they can save. Rising living costs force families to rely on credit simply to survive. Debt that once represented opportunity now represents suffocation. And when economic shocks appear, it is households that suffer first. The financial system is a chain of interconnected obligations. When one link breaks, such as a major bank, a corporation, or a government, others fall with it. This interconnectedness is why crises spread instantly. In 2008, a collapse in U.S. housing triggered a global meltdown. The next collapse may not start in America. It could begin anywhere and spread everywhere. Rising default rates, slowing GDP, surging interest payments, declining trade. A global banking system stretched to its limits. These signals are not random, they're symptoms of a system reaching collapse territory. Economists may avoid the term crisis, but the data speaks louder than words. The world is not approaching a debt collapse. The world is accelerating toward it. Sovereign defaults are no longer rare. Countries from Argentina to Sri Lanka have struggled to meet debt obligations, proving that even nations cannot borrow without limits. Each default sends shockwaves through the global economy, affecting trade, investment, and confidence. The warning is clear. Debt is no longer a tool, it is a ticking bomb. Companies that relied on cheap loans to fund expansion now face crushing interest payments. In sectors from real estate to tech, defaults are rising. Analysts warn that a domino effect of corporate bankruptcies could trigger mass unemployment, market volatility, and loss of investor confidence globally. The cracks are spreading beyond households and governments. In the US, Europe, and Asia, household debt has surged past historic levels. Many families spend more on interest than on savings or investments. When crises strike, households are the first to feel the pain. Defaults on mortgages, loans, and credit cards ripple through the economy. Debt is no longer optional. It is survival. But survival has a price. Central banks face a dilemma: raise interest rates to control inflation, or keep them low to sustain debt. Each choice has consequences. Higher rates increase borrowing costs, squeezing households, corporations, and governments. Lower rates may fuel inflation and asset bubbles. This tug-of-war shows the fragility of the system and the limited tools available to prevent collapse. Shadow banking remains largely invisible, but its scale is staggering. These unregulated institutions amplify risk, borrowing and lending in ways that traditional regulators cannot track. Any shock in this hidden sector could cascade rapidly, triggering crises that appear sudden but were silently brewing for years. Political instability and trade conflicts magnify debt risks. Sanctions, wars, and diplomatic standoffs can disrupt global supply chains and trigger defaults. Nations with high debt are especially vulnerable to geopolitical shocks. In a tightly connected financial world, one conflict in a small region can spark waves of instability worldwide. Climate change is no longer just an environmental issue, it is a financial one. Governments and corporations must spend trillions on disaster recovery, infrastructure resilience, and carbon mitigation. These expenditures are often financed through debt. By 2030, climate costs could push already fragile economies past their tipping points. The aging global population increases pension obligations, healthcare spending, and social security costs. Younger generations face stagnant wages and higher taxes. This demographic imbalance strains government budgets, increasing reliance on borrowing. The debt clock ticks faster with every passing year, and the pressure is structural, not temporary. Derivatives, credit default swaps, and complex structured products were meant to distribute risk, but instead, they concentrate it. These instruments link institutions in invisible chains. When one fails, losses cascade unpredictably. The tools designed to stabilize the system now threaten its collapse. From rising defaults and corporate bankruptcies to household stress and geopolitical risk, the signals are unmistakable. Economists may hesitate to speak publicly, but the data is irrefutable. The world is entering a zone where debt is no longer a tool, it is a trap. And the year 2030 looms like a deadline the world cannot ignore. Debt crises do not occur in isolation. Like a row of dominoes, one failure triggers another. A sovereign default in one country can cause banks to fail, corporate bonds to collapse, and investor confidence to vanish worldwide. Understanding this chain reaction is key to comprehending how a 2030 debt collapse could engulf the global economy. Banks are the central nodes in the global financial network. Money flows through them constantly, linking nations, corporations, and households. When a major bank fails, the shock spreads instantly through these networks. In 2008, Lehman Brothers' collapse triggered a worldwide financial meltdown. The interconnectedness that drives growth also accelerates collapse. Credit markets are where borrowing meets lending. They are the lifeblood of economies, providing liquidity for governments, corporations, and households. But in times of stress, credit markets freeze. Banks stop lending. Companies cannot finance operations. Households cannot borrow for daily needs. A temporary credit freeze can quickly escalate into a systemic crisis. In today's globalized economy, debt crises are contagious. A default in a small economy can impact trade partners, investors, and banks worldwide. The 1997 Asian financial crisis, for example, spread from Thailand to Malaysia, Indonesia, and beyond, triggering global market instability. In 2030, a single event could spread faster and wider than ever before. When debt crises hit, currencies often collapse. Governments may print money to meet obligations, triggering inflation or hyperinflation. Prices soar, savings vanish, purchasing power evaporates. Currency devaluation is both a symptom and an accelerant of financial collapse, leaving households and businesses exposed to sudden shocks. A sovereign debt spiral occurs when governments borrow more to pay interest on existing debt. Interest payments consume budgets, forcing more borrowing, and the cycle repeats. Once a nation enters this spiral, default becomes inevitable. Economists warn that multiple countries may enter these spirals simultaneously, magnifying the global risk by 2030. Debt crises do not only affect numbers, they affect people. Rising unemployment, declining social services, and political instability often follow financial collapse. Riots, strikes, and government collapses are historically common when debt burdens become unsustainable. The human cost of a 2030 collapse could be catastrophic. Debt crises can disrupt international trade. Supply chains freeze, commodities spike in price, and countries become unable to honor trade obligations. In 2030, a collapse in one major economy could trigger shortages worldwide, exacerbating inflation, unemployment, and social unrest. Trade is the connective tissue of the global economy, and it is fragile under extreme debt pressure. Fear itself can trigger collapse. Investors sell assets, banks restrict lending, and markets spiral downward. Panic is contagious. Once a debt crisis begins, psychology amplifies the financial impact. By 2030, with debt levels at unprecedented highs, this feedback loop could transform a local crisis into a global catastrophe within days. Countries with high debt-to GDP ratios are the most vulnerable. Nations such as Japan, Italy, and the United States have debt levels that far exceed their economic output. Any shock to revenue, be it recession, natural disaster, or geopolitical tension, could trigger defaults or forced austerity measures. These nations are on the front lines of the 2030 debt crisis. Emerging markets, though smaller in GDP, carry proportionally higher debt and often rely on foreign capital. Countries like Brazil, South Africa, and Turkey are exposed to sudden capital flight. When investors withdraw funding, these economies can collapse almost instantly, creating ripple effects in global markets. Some of the world's largest corporations are heavily leveraged. Industries like real estate, energy, and technology depend on cheap financing. Rising interest rates and shrinking credit could force bankruptcies in companies that employ millions, affecting markets, pensions, and consumer confidence simultaneously. Middle-class households in developed economies are deeply leveraged. Mortgages, car loans, credit cards, and student debt leave little room for financial shocks. Any rise in unemployment or interest rates could push families into default, amplifying the economic downturn through reduced consumption and social unrest. Major banks and investment firms are interconnected and highly leveraged. A single bank's insolvency can ripple through the global system. By 2030, financial institutions with excessive exposure to sovereign and corporate debt may face catastrophic losses, triggering global panic. Globally, pension funds are invested heavily in government bonds and corporate debt. If these assets default, retirement savings could evaporate. Millions of retirees would face financial insecurity, adding social and political pressure to economies already under stress. Countries reliant on commodity exports like oil, gas, and metals face high vulnerability. Price drops or trade restrictions can trigger debt defaults. By 2030, nations dependent on single-resource economies may collapse quickly when global markets shift or demand falls. The tech sector, fueled by venture capital and debt financing, carries hidden risks. Startups burning cash and leveraging debt may fail rapidly during financial tightening. A cascade of failures in tech could impact jobs, innovation, and broader markets. Ports, shipping lanes, and trade hubs are the arteries of global commerce. Debt crises can paralyze trade logistics, causing shortages and inflation worldwide. Cities like Singapore, Rotterdam, and Shanghai are especially vulnerable to cascading financial shocks. By 2030, no one is entirely safe. Nations, corporations, and households are all entwined in a fragile web. Those who are over-leveraged, over-dependent, or underprepared will bear the brunt first. Yet understanding vulnerability is the first step toward resilience. Awareness, preparation, and strategic planning may be the only shields against a global debt collapse. Before solutions can be applied, the crisis must be understood. Debt collapse is not a single event. It is a system failure caused by interconnected factors: sovereign, corporate, and household debt, interest rate shocks, financial instruments, and global interconnectivity. Awareness is the first step toward mitigation. Only by understanding the web of risk can nations, corporations, and individuals act strategically. Governments play a central role in preventing collapse, reducing excessive borrowing, restructuring unsustainable debt, and implementing fiscal responsibility are essential. Strategic spending focused on infrastructure, education, and productivity can create growth without adding to debt burdens. The era of blind borrowing must end to stabilize the system by 2030. Central banks must carefully manage interest rates and liquidity. Overly aggressive rate hikes could trigger defaults. Excessively loose policy could fuel inflation. Transparent communication, prudent planning, and coordinated international action are critical. Central banks are the last line of defense against systemic collapse. Corporations must prioritize sustainable growth over short-term gains. Reducing leverage, strengthening balance sheets, and diversifying revenue streams can buffer against interest shocks. Companies that act proactively will survive, while those dependent on excessive debt face collapse. Deleveraging is a painful but necessary step toward stability. Individuals must understand debt risk. Saving, reducing consumer debt, and diversifying investments are vital. Financial literacy programs can empower households to make informed decisions, mitigating the human cost of a global debt crisis. Prepared citizens become the foundation of resilience. Debt collapse is a global problem requiring global solutions. Coordination between nations on trade, monetary policy, and financial regulation can prevent contagion. International financial institutions like the IMF and World Bank must act decisively to support vulnerable nations and prevent domino effects. Technology can detect and manage risk faster than traditional systems. AI-driven financial monitoring, blockchain transparency, and real-time analytics can identify vulnerabilities before they trigger crises. By 2030, technology may become the key to preventing systemic collapse or at least mitigating its impact. Even with mitigation, preparation is essential. Nations must maintain emergency reserves. Corporations should have contingency plans, and households need emergency savings. Resilience is built not by avoiding risk entirely, but by preparing for its inevitable occurrence. History is filled with debt collapses from the Great Depression to the 2008 financial crisis. Each event teaches lessons. Transparency matters, leverage is dangerous, and panic is contagious. By learning from past mistakes, the global economy can reduce the severity of future crises. Ignoring history invites repetition. Debt collapse is not inevitable. With knowledge, foresight, and decisive action, nations, corporations, and households can navigate the storm. The key is awareness and preparation. By addressing vulnerabilities today, the world can face 2030 with resilience rather than fear. The clock is ticking, but action can still change the outcome.